Hi, Rick. Thank you very much for joining us today. How are things in Washington State?
Life is great. Thank you for having me back.
It's always a pleasure. Rick, gold is up over 20% on the year, and there are a few reasons why this is. And the primary one is because of stratospheric inflation that continues to be very resilient. And a big part of this inflation is coming from government spending. The government is currently spending about 26% of GDP, but only taxing 20% of GDP. And all of this spending is keeping the economy afloat, but it's generating record high inflation that just won't go away. How can gold protect investors against government mismanagement like we're currently seeing?
Well, it's very tough for governments to print gold. They can't conjure it into existence. People have tried alchemy for a long time, and not even government seems to be able to counterfeit gold, despite their success in counterfeiting other things. On a more sober note, I think it's worthy to note that the escalation of the gold price that you talk about, whether you talk about it this year, which is to say, up 20%, or if you take it back a little further, what you've seen is that the move in gold price has really occurred with very little retail participation. If you look at the statistics around physical gold ETFs, until about 5 weeks ago, retail investors in the Western world, at least, were dishoarding or selling gold. The strength in gold has been central bank buying. Now, I would agree with your statement that gold traditionally does well in the context of inflation. But what's kicked this gold bull market off, really, I think, is the weaponization of the US dollar. If, as I believe likely, that the follow-through is retail participation on top of continued central bank buying, then I think, Jimmy, you see a real move in the gold price. And that's what I'm anticipating will occur.
So let's talk about the central bank buying in a little more detail. In 2022 and 2023, they acquired approximately 25% of gold production. That's continuing on into 2024. But what are the reasons why the central banks are buying gold so aggressively?
I think it comes to two general things. First is the weaponization of the US dollar. The US government has decided, in their wisdom, by the way, whether or not you agree with US policy, to export US policy to other countries who may have their own agendas. The weaponization of the SWIFT banking system, which is not US property, but the US government has decided to do anyway as a consequence of the fact that it's denominated in US dollars. And further, the theft by the US government of $300 billion worth of Russian holdings of US treasuries. Again, whether or not you agree with Russia's policy or America's reasons to do so, has caused governments around the world who believe that they might come into the sights of the US government. As an example, the Russians, the Chinese, the Indians, the Saudis, to question their holdings of US Treasury securities and their use of the US dollar for international trade. A second problem, I think, is that the arithmetic around US Treasuries has gotten worse and worse and worse. We came through a period really of US dollar hegemony. I would suggest in the period 1982 to 2022, the internationalization of the US dollar and the decline in both nominal and real interest rates were tailwinds for gold. Now, I think that foreign countries in particular that look at the US dollar and look at US treasuries see an instrument which pays them 4.3, 4.5%. I'm talking about the US 10-year, in a currency where, separate and apart from the CPI, they see the purchasing power of the currency decline by 7 or 8% compounded. And so they're stuck with this sort of a conundrum. You invest in an instrument which gives you a negative real rate of return, and you do so while exposing yourself to the risk of the extraterritoriality of US policy. It's a real lousy bargain for those countries. It can't be any surprise that the Chinese, as an example, have reduced their holdings of US treasuries by about 70%, pardon me, over the last 5 or 6 years. In the first instance, they think that that investing in their own economy and in their Belt and Road strategy around the world yields higher real rates of return than they would if they were invested in U.S. Treasury securities. And they also allow themselves to escape, at least in some sense, the extraterritorial imposition of U.S. policy through the U.S. dollar. So it's no particular mystery as to why foreign holdings of gold have increased and foreign holdings of U.S. treasuries have decreased.
So you made mention of the fact that China reduced its holdings of U.S. treasuries by 70% over the last 5 years.
Correct.
So what would that be in dollars? How many
I
trillion?
don't. Well, I guess we could work backwards. If my memory serves me correctly, their holdings were 3.3, 3.4 T, and now they're under 1 T. It would appear that the only major country whose treasuries are effectively unchanged has been Japan. And I think for Japan, the reasons for that are twofold, but one of which probably involves their continued efforts to keep the yen cheap relative to the dollar so that they can continue to export items from Japan to the United States, which is to say, in effect, it's an employment strategy or a domestic political strategy for Japan. Well, that isn't necessarily true in other countries.
So that's what central banks are doing now. You made mention of the fact that investors, both institutional and retail investors, are not participating in the purchase of gold or gold equities. Why?
Not to the, well, in the last 5 weeks, my evidence comes from the ETF holdings. They have begun to participate. Why they didn't participate before is a matter of conjecture. My conjecture would be that gold is an instrument that reacts to fear. And we've lived through 40 pretty benign years, going back to the beginning of the lowering of the US interest rate in 1992, all the way through 2022. Stock market was up, the bond market was up, there was lots of liquidity. I'm not trying to say there weren't some punctuations, 1987, 2008. We had some pretty dramatic punctuations, but the lessons that we learned as investors in those punctuations were that you'd buy the dips. The truth is that people were pretty optimistic because financial markets were continuing to do well. This reminds me a bit, frankly, of the late 60s and early 70s, when all of the indications of inflation were in the system, but people hadn't experienced it yet. They'd lived through 2 benign decades after the end of World War II. And while people read about inflation, it wasn't until they had sort of 5 years of experience with inflation. It wasn't until they'd seen the price of gas at the pump go from 20 cents a gallon to $1 a gallon, as an example, that they began to internalize the lessons. And I believe that the same process is underway right now. We talk about inflation, we feel inflation, we think about inflation's impact on others, but we've been schooled through 40 years of pretty benign economic climate to be aggressive, not cautious. Now, my belief is that after 3 years or 4 years or 5 years, people will begin to understand the price that they pay for the diminishment of the purchasing power of the dollars that they earn working or in their savings. I suspect that you'll look at the CPI, which suggests that, quote, inflation is moderate at 2.6%. But you'll look at what happens to the basket of goods and services that you purchase that impacts your lifestyle. And you'll say, wait a minute. The purchasing power of my dollars isn't decreasing by 2%. It's decreasing by 7% or 8%. And if you experience that over 5 years, if you watch your rent, as an example, if you were a renter, increase by 6 or 7% compounded. If you watch the cost of a shopping basket full of groceries increase by 100% over 4 years, all of a sudden you come to the same conclusion that retail investors came to in 1972 and 1973, which is to say all is not well. And I think it's that consciousness that really kicks off a market in the metal.
Yeah, I agree with everything you just said 100%. I am really starting to feel the pain of inflation right across, even though the government says, oh, don't worry, we got inflation under control and we got it down to whatever the number is, 2.6 or 3%. Okay. Doesn't matter. The prices were already up from 40 to, or up 40 to 50% here in the last 4 years.
And let's
So,
talk about one other thing while we're at it, which is to say the probability of increases in the future. I don't want to give you a Canadian number because I don't know it. But in the US, the on-balance sheet liabilities of our government exceed $34 trillion. The off-balance sheet liabilities, though, Medicare, Medicaid, Social Security Trust Fund, military pensions, government pensions, all that kind of stuff, exceed, according to the Congressional Budget Office, $100 trillion. And we propose to meet these obligations with a budget that goes further into deficit by $1 trillion every 100 days. Now, how do we get ourselves out of this conundrum? Understanding that America's GDP is under $30 trillion, which is to say our GDP is less than our on-balance sheet liabilities and is 20% of a combination of our on-balance sheet and off-balance sheet liabilities. How do we solve this? Well, they say, tax the rich. Top 1% of Americans have an aggregate net worth of $5.8 trillion. If you stole the entire net worth of the 1% in the United States, you wouldn't have solved the debt. What you would have done is funded, something like 20 months of the deficit. So you got to throw that one out. Well, how about tax everybody else then? Good luck with that. How about curtailing benefits? Let's say to the old guys like me, hey, Rick, you voted yourself a whole bunch of cool benefits for 40 years. You forgot to pay for them. We're not going to give you the money. You follow me? There's a whole bunch of hard choices. And you know what? We faced those hard choices before. Not as hard, but we faced them in the decade of the 70s. We had unsustainably high debts. We couldn't raise taxes. So what did we do? We inflated away the real value of the obligations. The purchasing power of the US dollar over the decade of the 70s declined by 80%. So we didn't renounce the debt in the honest, old-fashioned way by saying, yeah, we owe, but we ain't going to pay. Too bad, too sad. What we did is we made the debt less important relative to the inflated dollars that we took in via taxation. So my suspicion is that the way that we deal with this $130 trillion obligation or series of obligations is that we, in effect, inflate away most of the present value of the obligation.
yes, no, there's no way they're going to lift taxes or cut spending, especially during an election year, right? And doing so would be political suicide.
How do they lift taxes enough? There needs to be some money left over for people to live on. There needs to be a little money left over to reinvest to make sure that the sustaining capital in the private sector continues to be strong enough that at least they can continue to tax. Meanwhile, in the United States, before local expenditure and before debt service, government currently consumes almost 40% of GDP. So how much can you raise tax? Particularly, how much can you raise tax relevant to the size of the obligation? Let's say, just for fun, and I don't think it'll happen, that you got around to balancing the US budget, which is to say you didn't increase the deficit anymore. How do you deal with the $34 trillion that you owe the bondholders? How do you deal with the $100 trillion that you owed folks like me for Medicare, Medicaid, and Social Security? Even if we found $3.5 trillion via increased taxation, we've shown arithmetically that can't come from the billionaires because they don't have it. How do you deal with the debt?
So once again, just to summarize everything you said, in this environment where we have stratospheric inflation or never-ending inflation and also never-ending debt, gold is one way to help hedge yourself against government mismanagement.
Certainly not the only way. Warren Buffett showed in the 1970s that if you bought companies that were world dominators and had pricing power and you paid the right price for them, that was another way. And I thought about that a lot. I've come to the not so stunning conclusion that I'm not quite as smart as Warren Buffett is. I am not as good a stock picker as he is, although I think, pretty good. What's available to most people is the instrument that has performed that function over 1,000 years, which is to say gold.
So we spent a lot of time talking about gold and the benefits of gold. It's up over 20% year to date. Silver's doing a little bit better. It's finally above $30 an ounce, touch wood. And it's currently up around 30% on the year, give or take. What are your thoughts on silver and does it keep going?
Well, you may remember an earlier ill-timed interview with me where I talked about the fact that silver lagged gold, that the price momentum had to be established by gold and then silver would follow through. And I was dumb enough to tell you that might take a year. And I think it took 3 weeks. It still remains a historically observable fact going back 50 years that precious metals bull markets are led by gold. When the momentum is established by gold, for whatever reason, and your listeners could speculate for themselves as to why that is, that when silver starts to move, it moves further and faster. I also made the point in that interview that speculators should look at the junior silver stocks, should look at them in particular because they were hated. And the easy money in speculation is buying what's hated and waiting till it becomes less hated. That's occurred in 3 months. I'm not trying to say that all of the easy money has been made, but I'm trying to say that the hate around the junior stocks, the junior silver stocks, has dissipated. I learned 20 years ago from Doug Casey that the market capitalization of the legitimate junior silver stock universe, I'm not talking about all the petty pretenders in the silver space, but the guys with legitimate deposits, the market capitalization of that group of companies is insufficient to hold the capital that comes into the sector. When the generalist investor comes touring into precious metals, and I think you're going to see that if gold continues higher, which I believe it will, and if past is prologue, when silver begins to outpace gold, and the consequence of that is that people who are looking to employ the precious metals narrative crowd into the junior silver stocks. I remember past silver bull markets, and they're truly something to behold. I came into the business in the early 1970s, and I remember vividly Coeur d'Alene silver going from 10 cents a share to $65 a share. I don't know. I don't know arithmetically what kind of return that is, but it's stupid for 10 years. I didn't participate because I was too young, too dumb, and too broke. But in the next silver bull market, I remember Silver Standard going from 72 cents to $45, Pan American silver going from 50 cents to $40 or $45. These are truly stupid moves if you have the psychological ability to stomach the volatility, and if you have the financial ability to speculate with some amount of money that you can afford to lose if you're wrong. It's worthy to note, by the way, and we've talked about this on your show before too, in all of those multi-baggers that I've enjoyed, I mean, none of them occurred over a long weekend, right? They take 5 years or 6 years to unfold. And in every circumstance, including Pan American and Silver Standard, during some period of time when they ran from below $1 to over $40, they exposed holders to 50% declines in share prices. And you need to be able to stomach that, both financially and psychologically. If you are, it's a very fertile place to speculate. And I suggest that in addition to that, probably now it's a timely place to speculate.
You know, when I hear you talk about silver and the moves that it's had in the past, it reminds me so much of what we're seeing in Bitcoin because those are the same sort of moves we've seen in Bitcoin. Last year was up 160%. This year it's already up 60% year to date. And but before we got, I think in 2021, we had a massive pullback. It was down 60 or 70%.
I think Bitcoin is probably a more fertile territory for a market observer like yourself. I think that involves a lot about investor psychology. And I'm not very good at that. You know, I can't even dress myself. I tend to confine myself to topics where I believe that my experience gives me an edge over competitors. And I don't have that edge in cryptocurrencies. I'm not suggesting that they're valueless. I understand conceptually the network effect. I understand the potential ease of transaction, you know, the frictionless cost that could be offered. I understand too the anonymity. I just have a difficult time personally understanding some of the value propositions. And I also don't have 45 years watching the crypto market to begin to understand how markets might react to changes in news. So I will leave discussions of the crypto to people who are better market observers than I.
So I got to ask you about silver. Gold has already taken out its all-time high. It's trading at or near its all-time high, but silver is nowhere near it. Is this the year we're going to see a massive move in silver and it's going to take out that $50 level?
The truly honest answer is I don't know. I've never understood the importance of things like the gold-silver ratio. Those rules of thumb don't, to me, discuss utility. And I believe that price is a function of utility versus scarcity. And the fact that that silver is 16 times more prevalent in the Earth's crust than gold is an example, or that gold has taken out its old nominal highs, and silver is only at 60% of its old nominal highs. I understand the observation. I'm just not smart enough to understand the relevance, if any. I'm also old enough and smart enough not to lock myself into a time frame like this year. Well, I'm tempted. Here's what I can tell you. When I look at the gold price, people ask me to set a target, and you know, I kind of say I don't have one. What I do have is a belief that for reasons that I understand and reasons that have valid historical context, that the preponderance of evidence says that the gold price will go higher and perhaps materially higher. That's probably all people need to know. That's as certain as they're going to really be able to get in life. If you look at the historic relationship then between gold markets and silver markets, it is likely, if past as prologue, that at some point in time in this gold bull market, that silver will move further and faster. It's true too, if you've observed the last four markets, that when silver establishes price leadership, that the most volatile of all precious metals asset classes is the silver stocks.
So, Rick, I want to ask you about equity valuations now. Mining, as we both know, is an extremely complex business. There's so much to consider, including metallurgy, grade, size, geopolitics is always a big one. So many elements which can impact a company's profitability. And when you look at Newmont, for example, the world's largest gold producer, it's down, or I'm sorry, it's up about 2% on the year. Okay. At the same time, where gold is up over 20% on the year. Barrick, the world's second largest gold producer, it's actually down 2% on the year. But like I said, gold is up 20% on the year. Why do we have this discrepancy between the physical and what some of these equities are trading at?
Three things, I think. The buyers in the gold market for the last 2 years have been central banks. They buy gold, not gold stocks. So while there's been a motivated buyer on one side of the equation, that motivated buyer, the buyer with the cash, hasn't cared about the other asset class. In the near term, that's probably the most important dynamic at play in the delta between the gold equities and the gold stocks. The second is that although the gold price has increased, and one would expect as a consequence of the product price increasing that the margins would increase, the costs associated with producing an ounce of gold have increased too. The social expense, which is to say taxes, royalties, off-concession expenses, have been increasing at 35 or 40% compounded. The energy costs of mining companies over 4 years have doubled. The labor costs are increasing at about 20% compounded. So the margin increase that you would hope to see as a consequence of a 20% increase in the gold price haven't occurred in the same fashion. And I'm afraid to say that the third reason is the performance of the gold equities during the last major increase in the gold price. If you'll remember back, and I'm sure you do, to the decade 2000 to 2010, in that decade, the gold price increased from about $250 an ounce to, if my memory serves me well, $1,800 or $1,900 an ounce. So you had a sevenfold increase in the gold price. And the free cash flow per share of the XAU fell. It took real skill for the industry to generate declining free cash flows per share when the selling price of their commodity went up sevenfold. Now, I suspect that that problem is, at least for a while, a relic of the past, in the sense that the management teams that presided over that destruction of value were all thanked and excused, allowed to pursue other employment opportunities. And I think that the institutional investors, myself included, have a real memory of that period. And we are looking at the interplay between the income statement and the balance sheets of major mining companies much more rigorously than we did in the past. In other words, I don't think that the managers would be allowed to be that stupid, even if they were predisposed to be that stupid. But I think until you see absolute growth in free cash flow per share on the XAU, that you aren't going to see broad increases in the gold price, in the gold equities that reflect the increase in the gold price. I think that margin expansion is going to occur in 2024, which means I think you will see companies like Barrick and Newmont begin to exhibit the margin increases that you're seeing in companies like Alamos and say Agnico Eagle. And if that happens, it's still an if. If that happens, I think you'll see a real romp in the gold equities. Traditionally, that romp has been led by the largest companies in the space. They have the liquidity to hold the extra money that comes in. But fairly quickly, when the big guys' share prices goes up, which means their cost of capital goes down, if the move doesn't extend to the mid-tiers, what happens is that the market arbitrages that out, which is to say the big companies with lower cost of capital take over the small companies with higher cost of capital. And I suspect that this whole thesis that we've watched historically time and again in the gold equities markets over the last 50 years transpires, beginning slowly, fitfully in 2024.
So, Rick, let me take the other side of that argument, okay? And let's just say the central banks have been very aggressive in bidding the price up, okay? Do you think the central banks have created an artificial gold price and that maybe the equities are actually factoring the true price? So it's not $2,400, maybe it's $2,000, maybe it's $1,800 an ounce.
If I thought that the U.S. government would cease the extraterritorial imposition of U.S. power on other countries, I'd be partway to a yes. The rest of the yes would require me to believe that the deterioration of the purchasing power of the US dollar was going to abate, which is to say, I would have to believe that we would solve the debt and deficit problem, that the United States would have to solve the spending problem, that the United States would once again be able to sell U.S. treasuries to foreigners and not have to counterfeit, quantitatively ease the U.S. dollar. And I don't believe that any of those are true. Because of that, I think that rather than being artificially high, what you have seen is that the foreign central banks were the first leg of buying, the first leg in the arbitrage between uh, gold and US dollar denominated fiat savings products. What other piece of data that I think your listeners might be interested in? I've probably used it on your show before, which is to say gold's market share. The market share of precious metals and precious metals related investments in the US market is about 0.5%, which is to say that less than 0.5% of total savings and investment assets in the United States are precious metals and precious metals related assets. The 4-decade mean market share is 2%. If gold merely reverts to mean, which is what I think is going to happen, demand for the stuff, by stuff I mean both precious metals and precious metals related investments, increases fourfold. And that's exactly what I think is going to happen.
Yes, that would be quite a move. Now, let me ask you about, we touched on Bitcoin earlier, okay, but we can't, I'm not going to let you off that easy, okay? Because like I said, Bitcoin's up 60% of the year, gold's up about 20. As you know, Bitcoin, the SEC approved Bitcoin ETFs earlier this year. It took gold ETFs 5 years to get to 5 billion. It took these Bitcoin ETFs 57 days to get to 5 billion in AUM.
Right.
And do you think there's a lot of investors, I guess, do you think Bitcoin is taking money away from the gold sector? And
I think on the margins, I think speculative money, yes.
Yeah.
If you consider the fact that the estimated net value of global savings and investment assets is about $800 trillion, the market capitalization of gold on the one hand and the market capitalization of Bitcoin on the other hand are, to quote Robert Friedland, two pimples on an elephant's behind. They don't matter in the aggregate. They aren't necessarily competitive with each other. They're competitive in the minds of retail speculators, to be sure. And I think that the allure of Bitcoin speculation has probably made the junior mining sector much less attractive. I don't think from an investment perspective that cryptocurrencies have impacted gold at all. I don't see the Chinese central bank or the Russian central bank or the Iranian central bank being large purchasers of Bitcoin. As far as I know, the only international investor in Bitcoin has been that financial stalwart, El Salvador. But I do think that you see perhaps the disintermediation from the junior gold sector into cryptocurrencies, which is to say the speculative allure of Bitcoin is probably there. I would suggest to you, however, that over the last 20 years, a lot of the speculative capital that might otherwise have gone into the gold sector went into technology, including big tech. The so-called Magnificent Seven, or now Magnificent Seven plus one, I think has attracted a lot of speculative capital. There are a lot of investors in those big technology companies that can't spell the products that they produce. So clearly they're not investors, they're speculators. But they're attracted to the narrative and attracted to the momentum. And I would suggest that a larger cause of the so-called dearth of capital facing the speculative resource sector has been technology and big tech, rather perhaps than crypto, given the relative market capitalization of technology relative to Bitcoin. I'm not diminishing what you say. I think that we have seen very strong performance in the cryptos in the last 5 or 6 years, which I think has caused some of the speculators, some of the so-called volatility worshippers, to go over to Bitcoin.
No, that's an excellent point, because if you go back 10, 12, 14 years ago, so many of the sectors that exist now didn't exist then. If you look at cryptocurrencies, EV, social media stocks, cannabis stocks, I'm probably missing a few, AI now, right?
Yep.
You have all these new sectors that didn't exist a dozen years ago, and now they are attracting trillions of dollars. So fair point.
Right.
Rick, as we wrap up, you and your team always have a lot going on in terms of events. Maybe you can tell us about some of the upcoming events.
Well, in terms of the events, my big event is coming up. The Natural Resources Investment Symposium is coming up July 7th through 11th. Your listeners could attend either in person, which would be my preference, in Boca Raton, Florida, or if that's inconvenient, they can attend via live stream from the comfort and convenience of their own home. In either case, we're going to give you about 60 hours of very intense, very valuable programming, more than you can absorb in the 4 days of the conference. So the proceedings will be recorded, and you can and should view those proceedings again and again. Two other points that I think make the conference a standout. The first is that every public company at the conference and every exhibitor has been vetted. At every other conference I know, the qualification for admittance is a check that cashes. At our conference, the shares have to be owned in accounts either owned and managed by myself. No guarantee, sadly, that because I own a stock, it goes up, but there is a guarantee that keeps the promise very honest. And that allows me to make you one other promise. If you come to my conference, either in person or via live stream, and you think that I haven't delivered value for money, that I haven't earned the tuition I charged you, email me. Gold-plated money-back guarantee. The financial risk of this conference is mine alone. In 30 years or so of making this promise, I've had to refund about 1/10 of 1% of the tuitions I've charged. But that notwithstanding, unlike any other conference that I know about in the world, I have the absolute confidence to say to my attendees, absolute gold-plated, no questions asked, money-back guarantee.
Well, Rick, that was great. I'm not going to be there in person, but I am definitely going to watch it online. So once again, I'm looking forward to it. And I want to thank you very much for being with us today.
Well, thank you so much for the opportunity. I enjoy these conversations. You've been in these markets long enough that the questions that you ask me occasionally stump me, which is fun.
Once again, thank you.